This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
For our regular attendees and subscribers, I displayed the trade alert log. We call this a trade blotter, and what you're seeing here are all of the trades that I put out through our service since 2010, which is when I started actually logging the percentage of accuracy. And you can see right here in 2010 we ended with 85.7% accuracy, and if I go on to 2011 you'll see that it was an 82.2% accuracy. And the reason I'm showing you these actual trades is because very few people, if any, will actually do that. And I don't know if it's not shown because people are afraid to show their losses, or they're just too busy promoting their best trades to show incredible 5,000% returns. I am very realistic, and I'm practical in the sense that I like to record everything that I do, so that if I'm ever challenged on any of that, I can go back to the record and say, okay, here's the facts, here's what went out, here's the symbol, here's the trade, and where it closed. Now in 2012, you'll see the 77.5% that you see there is the lowest percentage out of the 6 years, and you'll see that the number of negative trades right here, see negative, 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 were bearish strategies that we lost on, mainly because I was looking for a market top at that point in time because the prices were overextended, and I kept getting stopped out because the market was not ready to top out yet. So we started taking bearish positions, and it started moving against us. So that's one of the reasons why we have the lowest percentage. Now, I always tell people, if you're following the Market Guy strategies for managing risk, and if you're following the strategies for finding the buy signals or sell signals, you should have on the low end 75%. So what that is 3 out of 4 stock picks that you make using our system should be winners, and 1 out of 4 on average, and I'm being conservative here, 1 out of 4 should be a losing trade where you get stopped out at minimal loss. And as I progress, you'll see that 2013 was a good year. We had almost 90%, a lot of positives, and this is the year that I really started moving heavily into contingent buy orders or contingent trade alerts, where we were waiting for the signal. If you're not a subscriber, let me explain to you how this works. When I put out a trade alert, most of the time, and I say most of the time the markets are closed, and we have time to look at this, the trade, look at the charts, and get ready for a trade the very next day. So a lot of times I will put out a contingent buy order where I'm saying something like, okay, we have to wait for a green candle before we buy it, or you might want to wait in the last 15 minutes of the day before you buy it, or you might want to see the stock closing or getting ready to close above or below a certain price. And more or less the contingent buy or sell order is a trigger signal that we're looking for before we actually make the trade. And you can see that there's several times where we didn't have a trade at all because we just never got the green candle. So we abandoned it because the signal never came through for us. And as it turned out on those particular trades, it's a good thing we didn't trade them, because not only did we not get the buy signal, but had we bought it without waiting for the signal, it would have moved against us. So we wound up with a really good and strong percentage of accuracy for 2013. And then you'll see look at 2014 as we came in positive, a couple of negatives here, but we wound up with another very strong 86.27% accuracy, and 2015 came out with a fairly good one at 81%, still better than 75%. Now, this year so far, we've only had one negative one. Twitter, we got stopped out. It moved against us. I haven't checked on eBay. This trade went out last week, and I'm pretty sure we're up on this one. I thought I saw eBay up like 50 cents or something today. Yeah, eBay is currently closed at 24.34. So this could almost be marked as a positive. It hasn't hit the target yet, so I'm going to leave that blank. But most likely that's going to turn out to be a positive trade as well. So whoever traded that, congratulations for getting in. And so far, look at this. This is what I'm really most proud of. The running average since 2010 is 84.61%. And so when I go out there, and it sounds like I'm bragging, but I'm stating the facts that if I'm not the #1 stock picker in the world right now with regard to percentage of accuracy, I would love for that person to challenge me and show me their record. No one has challenged me. No one has even tried to have any kind of even a friendly competition. But my goal is to continue at least, and I say this conservatively, at least 75% accuracy. Because if you could pick stocks 3 out of 4 times and be right, and you know how to manage risk during the times that you're wrong, then this is a no-brainer. It's all numbers. It's all numbers based. The times that people get in trouble and they start losing money is when they start holding on to trades that move against them and they don't have a plan for managing risk or exiting the position. And that's what I try to help people with the most, is making sure that you're following the rules for managing risk. Because at any time, I mean, I'm talking any time now, this market can reverse, and in the blink of an eye, you could be down. And the last thing I want to see people doing is holding on to positions, hoping, you know, it'll get back to break even. And that's not realistic, because hope, #1, is not a strategy, and hope is more, I guess you could say, with regard to financial matters, hope is more of an emotion. You're hoping things get better, and you're stressed out, and you want it to get better so you can feel better, and that's not what we're doing. So as I told a few people last week, especially on the Scotia Web Seminar, make your own trade blotter. It's pretty simple. Just get a spreadsheet, an Excel spreadsheet, and copy what you see here. Just put the alert date or trade date, the stock, your bias, bullish or bearish, the closing price, and the 3-month trailing price trail. So I give it about 3 months because that's most likely the maximum we're going to hold on to a trade. As a swing trader, you know, it could be anywhere between 3 weeks and 3 months before it starts moving. And of course, if you get stopped out, even if it's on paper with a practice trade, then of course mark that down as a negative if you get stopped out, or if it gets to where an alert fires off because it's broken down below a support level if you're long, or above a resistance area if you're short. Okay, so I just wanted to show that to you because these are the facts. And I normally don't put that out because, I don't put the option ones out because if I put the option ones out, then people will know what my strategies are, and people are paying good money to pay for these strategies each and every week, and I don't want that to get out for free. So I don't post the option one because it just lays out our strategy right there for everyone in the world to see. Although the option positions are making money in a good strong percentage as well. So that's that. If anyone has any questions about that or setting up your spreadsheet, just let me know, and I'll be more than happy to help you out with that. Now, I have silver on the chart right now because I think it was the last open house, we showed this huge trading triangle here, and I drew this from a longer term chart. This is 3 years, connecting these highs back here. So I connected this high to this high, and I more or less drew it down to connect to this high down here. And what's interesting is that we're breaking out of this triangle to the upside, and you can see, remember, this is a weekly chart. Okay, so last week the volume was higher than the previous week by about 15 to 20% as it was breaking out. And so I have a very concentrated position in silver. I've made that very public. So when I do make comments about it, obviously I'm biased with a position. Now, with that said, even though there's a breakout here, I want you to notice that on Thursday here we gapped up. So I wouldn't be surprised if over the next couple of days we even come down a little bit to fill this gap. It might come down to maybe fill that gap and then maybe go higher from there. I'm expecting it to go higher, but the toughest thing about being long silver is when it gaps up. It's really frustrating because your account looks great when it gaps up and you have a long position, but you know in the back of your mind that the gap has got an 80% chance of filling. So when it goes higher like this and almost got up to 1540, I can't get too excited because I know it's going to pull back. So I try to relax with it, and I'm kind of disclosing what my buy order is. I have an order in this day right here was the 16th. We had a high of 1491. And on the close on this day, I put an order in. It was like 2 minutes before the close to buy it at 1488. And as I hit now because I was doing this in a retirement account, I couldn't put a market order in because you can't overspend, or you shouldn't overspend your retirement money, because then it gets complicated with taxes and things like this. You can't overspend the money. So I put a limit order in, and as soon as I hit the enter button, boom, the offering price went up a penny, and then it went up 2 pennies, and then it went 3 pennies, and I missed it. So what I did is I left the order in to buy SLV at 1488. So if it comes back down, I'm going to be buying more. And if it fills the gap, then what happens? There's an 80% chance that after that gap fills, the market will reverse, and now we're back on track making money. Now, I know I'm spending a lot of time on the silver, but gold is looking very similar. If you look at a 20-year chart of silver, you can see that this has been in a significant downtrend really since 2011, and this is really the first time, even on the monthly chart, where we're starting to break over this downtrend line here. And even on the monthly chart, it's hard to see. So what you don't see is there's a control panel that keeps getting in the way. And you can see that we are now showing higher volume on the month of March here, and we still have time left until the end of the month. So I think the volume is just going to continue to build here. And when the volume is going up, as the price is going up, you all know, or at least those who have been following us, you know that that's a strengthening move on the buy side. When the volume goes up, it tells us the buyers are getting more excited, they're getting more motivated, and that could very well lead to higher prices. So, I don't want to be too excited because I don't want people to just buy and not manage their risk. I'm in accumulation mode here. I'm buying for the long term, so I don't mind if silver drops a little bit because I'll keep accumulating it anywhere between 12.5 and 17.5. The name of the game for me is how many shares can I control. And let me tell you, when you're in accumulation mode, it's really not a stressful position because I'm doing this for the future. I'm doing it because I'm hedging against the failing dollar if that would happen. I am preparing for inflation down the road if that were to happen. And if I'm if I don't see inflation, or if the dollar doesn't collapse, then I still think, looking at 20 years of silver here, it's still at a fairly respectable price where I don't mind owning it. And if it doesn't go to 100 and it only goes to 20, then guess what? I'm still making 30% on my position, and I'm feeling good about that. Okay. Now, what I'm going to do is I'm going to switch to the diamonds, and then I'm going to go to a weekly chart first before I go into the daily chart. The diamonds here is, you'll see, this is weekly now. Each one of these candles is a weekly chart. You'll see that the stock has had 1, 2, 3, 4, 5, there's 6 candles in a row here. We're at a resistance point, and the volume is more or less stagnated here. I don't know, because this is only Monday, I don't know what the rest of this week is going to look like, but the odds are that we're going to see lower volume this week because we're approaching resistance, and there's also a gap that was filled last week. Now, let's do a test. What happens 80% of the time after a gap has filled? Who would like to be the first one to answer that? 80% of the time after a gap has filled, what do we generally see? Paul Farley was the first. Jan, welcome back. Jan was the second. Larry, Amalia, Lloyd, Philip, you're all right. You're all right. 80% of the time after a gap fills, and here's the gap I'm circling, 80% of the time, if the market gaps down and then the market goes back up to fill the gap, there's an 80% chance that it will reverse from that point. And that's number one. Number two, rarely do you see gaps left open on weekly charts. Here's what I'm talking about. Here's a gap up. You see this? The market gapped up, and it kept going up. This is the Dow now. And what happened? It filled the gap here. For another couple of weeks, it kept going lower before reversing and going up. So here's a gap fill. It followed the 80% rule, where after it filled, it then reversed up. So here, last week, the gap filled. We're at a resistance point. There's an 80% chance that the market is going to drop. Now, that's not 100%, so I can't say that I am absolutely certain it's going to drop. I could also reword that and say there's an 80% chance that it will drop. And if the volume starts falling and drying up, that only increases the probability of the market dropping. And we just have so much now pointing lower, and it's why I think we should all be very, very careful with any long positions. Okay, now if I zoom into the daily chart, you'll see here, okay, Larry, I'll get to that. That's a good point. Larry said stale, green stale light, and that's true. Now, these are the lines that I drew from last week's report. And I don't know how many of you are following the weekly market report, but I did say, now this is Friday, and my partner Bill, who's recording this right now, he gets the weekly market report right after I record it, and then he adds the bumpers on it and the fades and all the technological stuff on there. And but I did say we would go a little bit higher. And today, what happened? We have a green candle. We did go a little bit higher. Now look, isn't this interesting? Because, and going back to what Larry said, there's 1, 2, 3, 4, 5, 6, there's 7 green candles in a row, and that's called the stale green light. And I often refer to the traffic light. If you're driving down a long road, a highway, and way up in the distance you see a green light, you know that as you get closer and closer, and as long as that keeps staying green, the probability of it turning red becomes greater and greater as you get closer to the light, right? And that's exactly what's happening. This light has been green for a long time. Today is the first day that we've had a drop in volume over the past almost 7 days. So there's the telltale sign, and this is why I get so excited about showing people about how volume is the leading indicator. Yes, the market went higher today, but the volume went lower. So that's telling us that the buyers are losing some of that momentum. Now, tomorrow, we could still see a little bit of a green candle, and we could still see lower volume. That happens quite often, actually. And it could even be where tomorrow the market opens higher and even gaps up and then closes lower with a red candle. See, if it opens higher and closes lower, it could still have a higher high, higher low, which by definition would still mean an upward trend. But the red candle tells us, uh-oh, sellers are starting to come in at resistance. And again, this is recorded. I want people to go see our members get the recording so that they can use it as a tool in their library. I always encourage people, here I am making a recording, use it, because two or 3 weeks from now you can go back to the recording and you'll see how it played out, because you'll have your live charts in front of you. You'll be able to see, wow, AJ on that day said it could go higher and it could be a red candle, and then all of a sudden you see the red candle and you think I'm a genius. And I'm not a genius. I just know how to read the price charts really well, and that's what I'm trying to teach all of you to do the same thing. And it starts with knowing what to do with the volume, and it starts with the common sense ideas of a green light, a stale green light, or a stale red light. And it's combining that with the gaps and resistance. And when you learn the language, you'll see that it becomes very, very comfortable over time. And to the point, it can be so comfortable, you'll start teaching people that you know, particularly family members, and now, guess what happens? The signals become more accurate, right? The fundamentalists go crazy when I say that, because they think, oh, well, a chart is nothing but self-fulfilling prophecy. Well, think about this. If an analyst, let's say Stuart Morgan is a big-time analyst for one of the major banks, let's say Bank of America or BlackRock hedge funds or whatever it may be. Let's say Stuart is a very well-respected analyst who is followed by many thousands of people. And then all of a sudden, Stewart says, "Oh, we're hitting resistance. I think we're going to go lower over the next couple of weeks." I can bet you my last dollar that Stewart will move the market, because his audience is reacting to his signal, his sell signal, his sell recommendation. Well, what's the difference? Here we're looking at a chart. We can see where resistance is. That's drawn right from the previous resistance. We could read the volume. Right? We all see this. And what is that? That's just the pulse of the market. It's measuring the momentum behind the market. And if all of us and all the people that we teach go out there and start reacting to the signals because we're seeing it as plain as day on this chart, what's the difference of that versus Stewart putting a sell recommendation out? I think the charts have more, they have more validity, because you're showing more history versus having one person give an opinion based on whatever they're researching. So this is how I'm reading the market. And the other thing you have to understand is down here, right around 160. Can you see this? There's a small gap below the market. There's a small gap from there to there, and that gap is still open. So there is a chance that when this thing starts to fall, that we could come all the way back down to 160 and fill that gap. And doesn't look like much on the chart, but if the Dow comes down, if the diamonds come down to 160, that's going to be a 1,600 point drop in the Dow. And if I'm telling you there's a high probability it can go lower here, then all you have to do is use your common sense and say, well, signals are showing more bearish signs. There's a gap below the market. You know what? I think I'm going to put all my buy ideas on hold right now and preserve my buying power. You see, doesn't that make a lot of sense? Now, when you have all this buying power preserved as far as cash in your account, and it goes down to 160, and the gap fills, and now there's a chance of it reversing, now you can take your buying power, and once the gap fills, you can go ahead and buy with that money and now you're in a really good position waiting for the bounce to occur, and now you're in a profitable position. So that's what we're talking about. Now Steve says, anything notable on the 100-year Dow? Yeah, there is, Steve. I just don't have 100 years of data on this particular chart. But if you look at a 100-year chart of the Dow, it's pretty scary, actually, because we are long overdue, and I'm talking way beyond what most would call a correction. We are long overdue for a major market move lower in a cycle. And go ahead, go after you get off this web seminar, go online and you can Google images and look for a Dow chart going back 100 years, and you'll see what I'm talking about. It's gone almost straight up since 2008, really. So very, very got to be very careful there. Okay, now let's go to the spiders. SPY. I left my lines from last week's report on there so you can see. Same thing. You know, I said we can go a little bit higher before going lower, so I'm leaving that in place right now. Interestingly enough, again, look at the volume. The volume is lower today. I'll zoom in here for you. See? And you know what's really interesting, folks? You see that little red line right there? I drew that last Friday when I said there's a good chance that on Monday the volume will be lower. And I drew that line right there. And look at how close. I mean, holy mackerel. We're only talking maybe, I'm guessing maybe 100,000 share difference in volume right there. And I'm thinking, wow, that's really pretty amazing. And sometimes I even amaze myself at how I'm not only forecasting price, but I'm even forecasting what I think the volume is going to do. And mainly that became evident because of the stale green light that I identified on spiders as well. So why am I showing you this? Because these are things that you should be practicing. Why are all these birthdays popping up? Holy mackerel, let me get rid of those. All right, so what you need to do is do what I did on that spreadsheet, put your spreadsheet together, and add a column for notes, all right? And make your own forecasts. I mean, especially when you're practicing with no money. If you're practicing and doing what we call paper trading, throw some notes on there. You know, these are notes to self. And you're writing on the margins and you're saying, okay, tomorrow I think that the volume could do this, or I think the price could do this. And track your own forecasts and see if you're right 3 out of 4 times whenever you do that. And then when you are confident enough to say, okay, I'm right 3 out of 4 times, then put your money on the line. And then still only do it in small amounts until you get comfortable with that. Okay, so this is a gap fill. Last week the gap filled right there, 80% chance it's going to drop. There's still gaps below the market in the SP just like in the diamonds. Let's go to a more broad-based index. That's the Russell 2000. And see how slow that screen is? Russell 2000, I said the same thing. I'm not going to zoom in. This is a roll reversal line. Former support. See, it bounced off of support back here. And then the support was broken, kind of like you're walking on a thin sheet of ice on the lake. What happens when you fall through the ice? What used to be the floor is now your ceiling and you're underwater. So the stock has to get back up over this for it to be healthy, and it doesn't look like the Russell 2000 is really agreeing with any kind of bull indication. It's looking pretty negative right here, and there's even a gap down below, a very small gap right around 1,000 right here for the Russell 2000. So when you have the Dow, the spiders, and the Russell 2000 showing gaps below, and there's an 80% chance that it'll fill, then again, all eyes are to the downside at that particular point. Let's look at the Qs. This is the NASDAQ market. And again, I said that we would go higher, and I do believe I mentioned that the NASDAQ was looking slightly stronger than the other indices. And lo and behold, look what happened. We had a bullish engulfing pattern here today on the NASDAQ. The only thing that does not really confirm that as a very strong buy signal for NASDAQ is that we had lower volume there. If it was stronger volume, I would say, you know what, NASDAQ has a greater chance of going up, and it could happen. There's days where the NASDAQ is up and the rest of the markets are down. There's still a gap that's unfilled for the NASDAQ. You see that? So I still think that the NASDAQ could go a little bit higher. I don't know if it's going to go all the way up this week to fill that gap. But the interesting thing is that the NASDAQ is caught between two gaps. There's a gap to the upside and there's a gap to the downside. So this whole area is more or less a trading range for the NASDAQ. And it's one of the reasons why I went into eBay last week. Just quick, go to eBay, take a look. Last week we put the buy signal out on eBay because we had that doji there, and lo and behold, we went higher. So this is going to be interesting because my forecast is that eBay has a gap to fill up here. It's still cheap enough to even buy it at these levels, but you have to put your stop right below these lows, or if you want to go a little bit further, you can put your stop down below this support level. If you have not yet gotten into eBay, then it's really not too late to do that. Of course, it would have been better if you did it last week, but it's still not a bad thing to do that because it's a NASDAQ stock, and the NASDAQ's stocks are looking stronger than the other ones that I've mentioned. Now, finally, the VIX, and then we're going to get right into your stocks so we can analyze them. The VIX, I said, we can go a little bit lower. That's what this little mark was. You see this? Very close to a bearish engulfing pattern here on the VIX. So I still think the VIX could go a little bit lower. And remember, it's a contrarian indicator. So if the VIX goes lower, the S&P could still go higher. And we already talked about the S&P possibly going higher. But what's happening here is we have a stale red light on the VIX. What is that? 1, 2, 3, 4, 5, 6, 7. I don't know if that's red. It might be. Let's go with 8 red candles. So we're long overdue for a green. So we could go a little bit lower, maybe tomorrow, which means the S&P will go higher. And then watch the VIX. Watch how it bounces. This is again, one of those leading indicators that everyone should be tracking on your watch list. Everyone. You look at volume first on your charts, look at the VIX, and you can play these two together, and you'll be amazed to see how accurate, when you combine those two leading indicators, how accurate you can really get with your forecasting. And it gets really, really fun when you start to really put out some strong percentages of accuracy on your own. Okay, who would like to be the first one? Is that American Eagle Outfitters, Ron? AEO. Let's see. I think that's what that is. Let's see if I'm still remembering my symbols. Yep, American Eagle Outfitters. All right, Ron. You're looking to buy. I would get out of that idea. And let's listen. I hate to pop the bubble if you're in love with the company, but let's analyze it. Okay. You have an almost vertical price move here. That's number one. Number two, you have what's very, very close, if it's not already, a bearish engulfing pattern. And you have the stock showing that bearish engulfing pattern almost to the penny of that resistance area. So I personally would not buy it here for just what we're seeing right here. And if you look at the volume on there, let me see if I can get this to shrink a little bit. I have to let me get rid of some of these. So I have again, you can't see the panel that I'm looking at. It's a little annoying actually. But look at the volume. We have a lower volume than on Friday, which tells us the buyers are moving out of the way. They're not in force anymore. So if you have some already, I would probably sell it. If you're thinking about buying it, I wouldn't buy it until, so I don't want to leave you hanging there. I wouldn't buy it until I see a roll reversal off of here. Here's former resistance, right? The ceiling was broken here. So I wouldn't do anything until I saw a bounce off of 15. So Ron, what I would do is I would put a price alert for right around 1505. And when the alert goes off, it means that you got to be on standby and wait for the bounce. Just because the alert goes off because it's trading at support doesn't mean you should be buying it. In fact, it means get ready to buy it, and then you have to wait like your own contingent buy order. You have to wait for the bounce and then buy it, and then you can put your stop somewhere below support if that helps you. Okay? All right, let's see. Paul says, do you sell calls against SLV position at what strike? Paul, I'm not selling any calls against SLV because although I think the gap could fill, silver is still looking very strong. So you don't want to sell calls against any position if you think the stock is going to go up in a big way. And I think silver could go up 30% from these levels. So I wouldn't do that. I'd just hold on. All right, Nazaire, I'm sorry if I'm mispronouncing your name. I'm sorry. I don't have stocks on the Toronto. If you have a U.S. stock, this particular platform only shows U.S. stocks or American depository receipts, foreign stocks that trade on the exchange. So Sean has, if you want to resubmit a symbol, I'll take a look at that. Okay, now Sean is short Alibaba. That's BABA. And let's take a look at this. Now, I like your idea of being short at 78 for several reasons. The stock is very, very close to filling this gap right here. It's very, very close. Now, Sean, understand, it still could go a little bit higher to completely fill the gap. But what you saw today is this long shadow. Let me zoom in here so I could show you what I'm talking about. This long shadow means that early during the day the market went up to that high and then the sellers pushed it lower. In fact, I could show you what that looked like on the minute-by-minute chart. See, it opened up high here and then it traded lower. So it gapped up actually on the opening, and then the sellers pounced on it throughout the rest of the day. And when you see these long shadows above the market, that's usually bearish. In fact, you see one back here. So although it still could go slightly higher, I like your idea of being short the stock because there's a gap. Once this gap fills up here, 80% chance it'll reverse, and then there's a gap down here. So, and there's also a gap because it gapped up this morning. There's a gap here, there's a gap here. So you got gaps that will most likely pull the stock back down here. But also remember, when you take a short position, you should not be in a short position for a long-term play. I don't want to have a play on words here, but short-term short positions are just that. You never short a stock and say, oh, okay, I'm gonna stay short this stock for the next couple of years. Not the way to do it. It's very short-lived. So what you have to do is you got to put a stop. I don't know how many shares you shorted, but if it starts trading over this level right here, right around 85, it might be time to get out of that. So be careful. I don't know where you have your buy stop there, but just be really, really careful. Okay, Philip is long 500 shares of BWLD. Let's see. BWLD, Buffalo Wings Incorporated. Okay, now I have to ask you, Philip, and please, you're going to help a lot of people with your answer to this. Number one, when did you buy the stock? Because I see it's been in free fall here for a while. When did you buy the stock, number one? And what prompted you to what prompted you to buy it if, in fact, the candles were red? See if you could help me with that. All right, let's see. Um, let's see, where did that go? Philip, I know there's a little delay there. So Philip, if you want to answer, that's okay. If not, I'll just analyze the stock. All right, let's see. Where is that? Okay. Okay, yeah, trying to catch a falling knife. NCAA basketball. I think you're serious. You bought it because of because of March Madness? All right, well, the good news is there's a long shadow under the candle. And although the volume, it wasn't really higher than it was on Friday, it was about the same. I think you're actually going to make money on this, not necessarily because of March Madness and NCAA competition, but because of the fact the stock has dropped so dramatically, and that long shadow could very well make you some money. All right, now, here's what I think the stock could do. I'm going to show you how to analyze and forecast angles. This is the previous angle of the last up leg. You see that? So this stock has a strong pattern of keeping that uptrend in those angles. You see that? See even from this low to that high, right there. See the angle? It's pretty. So what I'm going to do is I'm basically going to run my uptrend parallel to these. See that? Because that's the pattern. All I'm doing is duplicating the pattern. So what I would say, Philip, is if you go ahead and buy that, or you bought it, I would look for a 50% retracement of this down move. So I'm talking, if you buy it at 145, I would probably get out around 155 to 157. That would be my target. And hopefully you put a stop down below support somewhere. I'm not going to take up time doing that because you should have a stop somewhere, and hopefully you're using the 1% rule to do that. Okay, so all right, I see a message from Sean in Michigan there. Okay. Oh, I got it. Okay, got it, Sean. All right, I won't announce that, but I got your message. Okay, now Jan, MIC. Let's take a look at MIC. Now, Jan, I just see a symbol, but I don't see what your intention is. Folks, if you put a stock symbol in, let me know what your intentions are so I can help you better with that. Okay? And like Bruce, I'll get to yours. I'll get to yours in a minute. So, Jan, if you could put in what you're looking to do on that. I wouldn't be buying it. So if you own it already, I would be selling. Here's why. Look at the stock. First of all, for the year, it's been in a downward trend. That's number one. Number two, look at the volume of the past 3 days. Boom, it's going down dramatically. So it's at a resistance point, number one. It's just recently filled the gap here. Right? So it's filled the gap back here too. You have dojis and spinning tops up here. There's a great chance, not even a good chance, there's a great chance that the stock is going to pull back. And you might think, well, how did you draw that angle? Because, again, I did the same thing like I did in the previous stock. I'm looking at previous down legs from that high and following them. See, I'm more or less drawing this line almost parallel to the way these lines are. And so I think that stock could very well go down. So, Jen, if you're long it, I would sell it. And, again, this is my opinion. You could do what you want. But after that, I wouldn't look to buy the stock until I see a breakout of some of the resistance. Because, like I said before, it is in a longer-term downward trend. Okay, now let's get to Bruce Weiss because he's typed in CL. Bruce, I don't want to even give away your secret, so I'm not. But put it this way, Bruce made himself very noticeable. So, Bruce, I'm going to look at CL. Bruce is long it at 69, and it looks like it's gone up nicely, But, you know, Bruce, I'm looking at the stock and I'm seeing the volume drop, and I'm seeing the stale green light, and I'm seeing resistance from back here. It's at a resistance point. Look, see? That's from the high back here all the way to the left-hand side of the chart, March of 2015, about last year. So it's at resistance. It's gone up quite dramatically. The volume is dropping. I know $1.50 or so is not a whole lot of profit, but I would certainly hate to see it turn this winner into a loser because, you know, because you think it's going to go higher. Can it go higher? Yes. But why am I not thinking it's going to go higher? It's all the volume. Remember, I just talked about the volume being a leading indicator. And here's the weekly chart, and you can see that the stock has bumped its head quite a number of times at this $70 level up here. Now, if the volume was increasing on the way up, I'd say hold it, boom, because there's a good chance that it could break through the resistance, but it doesn't look like the volume is going to get much higher. So therefore, the resistance could hold. Think of it this way. Think of it as, okay, I'm in my car, and I'm heading towards a wall going 5 miles an hour, and the brick wall doesn't look like it's going to be broken by my 5 mile an hour speed limit on the car. You know, what do I need to break through the wall? I need momentum. I need volume. I need something that push me through the brick wall. And in this case, the volume would be the gas pedal. And I'm just approaching the brick wall here, and I'm letting up on the gas. So it doesn't look like that one's going to go. I could be wrong, of course, but I'm just telling you the odds are probably 75 to 84% chance that it's going to go the other way. All right, thank you, Bruce, for that. I really appreciate it, folks. Let me just say a couple of things here. We are coming to the end of the first quarter in this new year. And I'm still calling it a new year because it's the first quarter still. And a lot of things happen when people end the first quarter. You got tax filings. You got people getting ready to get into the April 15th mode. We're in an election year. There's all kinds of things happening. The dollar is crazy. I spoke with a gentleman today who is actually in Abu Dhabi, and he was telling me that a lot of the oil companies in that economy have laid off 60% or more of their workforce. That's because oil has taken such a big hit that these oil companies are dramatically laying people off. Now think about that. If let's look at oil. I want to show you what's happening and how world events could affect your position. This is the oil going back for 3 years. This is OIL, and you can also look at OIH. Let's look at OIH as well. That's the Oil Service Trust, and this has taken a beating. Now, I'm pretty bullish on the oil now because think about it. Think about why. It's very similar to why I'm long silver. And this is how you have to think when you're looking at the markets. If the oil companies are cutting back on employees, that means they're cutting back on production as well. So if they're cutting back on the production, that means less oil is coming into the market. So eventually the inventories will be gobbled up and demand will start to come back in. So I don't mind getting long OIH down here at 27. We have an option position in this where I think we're short puts, and I like it. Yeah, I think we're short the 19 to 23 put spread. But this looks pretty bullish. Even though it's been a downward trend, you can see how the volume is holding steady at the lows. That means they're accumulating. The funds are accumulating. And if at the end of this week we have higher volume like we have over the past 3 weeks, this could be one of those cases where oil breaks out of that minor resistance and goes higher. And then what do you have? Who could identify if we go higher from this level? What is this whole pattern called? Can anyone tell me? Who has been really good at practicing their price patterns? I know there's a little delay there. Who can identify that? Okay. I don't see anything, a little delay. Yeah, this could be a cup and handle pattern. It could also be a big head and shoulders pattern, a head and shoulders bottom. And so if that's a head and shoulders bottom, you could see OIH go from 27 all the way up to 40 and retest this resistance up here. You see? So even though I'm bearish on the general markets, there are isolated stocks that I would still consider buying, but you have to look at the markets and think this way. Not every stock is going to follow the Dow or the S&P or even the Russell 2000. There's going to be whole industries like the oil market and like the silver market and like the gold market that could actually work inversely to the other indices that I mentioned and could wind up making you some money. So I ran out of time. I certainly didn't run out of content. I want to thank everyone for bearing with the delay at the beginning. And please stay tuned to the Market Guys. We are going to keep you updated through different levels. If you're a subscriber, make sure you download the What's Up app. If you don't want to do that, make sure you subscribe to the Market Guys Facebook page, because I let you know when I've delivered the trade alerts. And if you have anyone who's interested in any of our services, just have us email us, and I'll be more than happy to roll out the red carpet for them. So, again, thank you. Have a good rest of the week. We'll talk to you soon. Good night.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.